Welcome to Clear Perspectives, the second quarter 2026 Marietta Economic and Financial Market Outlook. Today's Thursday, April 9th. I'm Mary Allmon, partner and portfolio manager. As I reflect on the start of 2026, the Marietta team had a very constructive outlook. We were focused on consumer spending, robust capital investment, strong corporate earnings, and supportive monetary and fiscal policy really across the world's major economies. 3 months later, those fundamentals, most of them they really still are in place. But now they're facing a powerful geopolitical shock in the US war with Iran and the closure of the Strait of Hormuz. This has created a global supply shock, most acutely seen in oil, natural gas, and fertilizer. At the end of March, oil prices had surged more than 80%, trading near $104 per barrel. This is a meaningful headwind for global growth, and the longer the disruption persists, the greater the negative economic impact. That said, there might be some important counterbalances happening. If the April 7th ceasefire and negotiations are successful, and they're able to reopen the Strait of Hormuz rather quickly, much of this damage could be temporary. And in that case, I think the underlying economic strengths would start to reassert themselves and lead to overall positive market outcomes. Given the uncertainty and the geopolitical conditions, we've lowered our global GDP growth forecast for 2026 to about 2.5%, and that's going to be below the IMF's pre-war projection. Our forecast assumes we're able to reach a negotiated halt to the war and reopen the strait in the second quarter. We expect inflation to rise, though its duration and magnitude that will also depend on how long energy prices remain elevated. The US economy is really testing resilience, though. It was actually losing some momentum before the war had started. Fourth quarter GDP was revised down to about 0.7%, a sharp deceleration from the third quarter's 4.4%. I think the labor market is the key area to watch, and the deterioration there, it's been a bit underappreciated. Over the last 9 months, the US economy shed 32,000 net payrolls, and benchmark revisions reduced total job growth for all of 2025 to about 181,000 jobs. Long-term unemployment, that has also risen meaningfully. While the unemployment rate itself, that is not concerning, it's the trend in hiring that deserves close attention. I think a sustained improvement in labor data, that would be necessary for us to improve our outlook. Importantly, this is not an economy in free fall. Business surveys, they remain in expansion. Service activity, they just posted the strongest reading since 2022. And manufacturing, we've seen expansion now for 2 consecutive months. Data center construction and AI-related capital expenditure, that continues to be the major support in investment. And while consumers' spending, it's uneven across income levels, it's held up on the aggregate. The question here is whether the US can withstand a sustained energy shock that raises costs for both businesses and households at the same time. We've reduced our US GDP growth forecast to about 2 to 2.5%. Higher oil prices will act as a tax on consumers, and with diesel near $5 per gallon, we expect this pressure to move across the broader supply chain. Inflation that had started to improve, it's likely going to re-accelerate above 3% in the coming months. And a prolonged period of oil above 100 would push inflation even higher and growth lower, raising the risk of recession. Financial markets have responded to everything very quickly. US equities declined meaningfully in March, with the exception of the energy sector. Traditional defensive sectors, they really didn't even provide as much protection, reinforcing a pattern that we've been seeing. When oil prices rise, stocks tend to fall. Until investors gain visibility into the resolution of the war, we expect markets to remain sensitive to geopolitical headlines rather than bottom-up fundamentals in the near term. International markets, they face an even more complex challenge. The core issue for this is energy dependence. Asia-Pacific economies consume the majority of Persian Gulf crude exports. Europe is highly exposed to natural gas disruptions. India is going to be vulnerable to higher fuel costs weighing on sensitive household budgets. China might be the notable exception. With a diversified mix of energy, large strategic reserves, and ongoing deflationary pressures, we think they might be better positioned than most countries to absorb this shock. Overall, the constructive case for international equities has eroded somewhat. The US, as a net energy exporter, is relatively better positioned, and the dollar has strengthened since early March. We are still constructive on international exposure long term, but I recognize that the valuation and policy tailwinds that supported the major 2025 outperformance, that's offset meaningfully by geopolitical and supply-driven headwinds. Although a swift resolution to everything would provide an outsized benefit to international stocks. Despite near-term volatility, the fundamental case for equities has not collapsed. Corporate earnings remain a central pillar, and valuations have actually moved closer to historical averages. On monetary policy, while inflation dynamics, they're far more complicated, we do not expect the Federal Reserve to increase rates in 2026. Our base case is a hold through the summer with a possible rate cut later in the year. In fixed income, bond markets have repriced in an orderly way. Higher yields reflect structural realities, making high-quality, short to intermediate maturity bonds attractive for income without unnecessary duration or credit risk. In the near term, markets are driven by geopolitics, but over the long term, we do think fundamentals still matter. Our focus remains on discipline, selectivity, and patience, positioning portfolios to navigate uncertainty while staying aligned with long-term objectives. As always, thank you for watching, and I invite you to share your thoughts and comments with us.